Hello, I'm Jean Pisani-Ferry. I'm a Tommaso Padoa-Schioppa Chair at the European University Institute. And today I'd like to talk to you about the way climate change, but also climate action, climate policy, are changing the macroeconomic and financial landscape. So climate and climate action were once regarded as issues for the very long term. And indeed, they are issues for the very long term. They are important issues for future generations. And the way we looked at it usually was to think, this is something we have to tackle over a 30 years horizon or over a 50 years horizon, and it's important that we limit the rise in temperature for future generations. And what has happened recently is that the horizon has shortened. It has shortened enormously because of the realization of the dangers of temperature increases. And those dangers are shorter term, they're more imminent than thought before. And so we've seen country after country setting targets that are more ambitious for 2050, but even also more ambitious, much more ambitious for 2030. And this is what the EU is currently doing. And the consequence is that what was beyond the macroeconomic horizon of policymakers or forecasters has moved or is moving into this horizon. So it's something that everybody now has to take into account. It started actually with those in charge of financial stability. In 2015, Mark Carney, the governor of the Bank of England, made a famous speech explaining that as a financial regulator, he thought the climate-related risks had to be taken into account and basically warned the industry that if they don't pay attention to those risks, the regulators would pay attention for them. He warned about the risk of what was called stranded assets, so assets that lose value because of their exposure to climate risk, or because they would simply lose value as a consequence of the economy moving away from fossil fuel or carbon-intensive industries. And he said that this has to be taken into account in the assessment of risks, and therefore sent a strong warning to the financial industry. This had some effects, and we've seen gradually, regulators, central bankers increasingly moving into climate. Central bank created the network for greening the financial system. The community of regulators is increasingly concerned. The industry itself is defining standards. Institutions like the IMF are more and more interested. But so that was sort of more on the financial side. What's happening now, it's taking place also on the macroeconomic side, meaning that because climate action is taking shape much more strongly, the question is how will it affect the usual variable? How will it affect growth? How will it affect investment? How will it affect public finances? How will it affect the labor market? And this is becoming really a very topical discussion. In general, we have to say that when you put a price on something that was used for free, the atmosphere, this is having a detrimental effect on your potential output. You have to pay for something you didn't pay for, so it's an increase in costs. And the response to this increase in cost, which can come actually either from explicit pricing or from implicit pricing through regulation, the consequence of this increase in costs is that economic agents respond by changing the capital stock, by investing more in green capital, moving out of brown capital, which is exactly what you would wish them to do. but which also has the implication that in order to produce the same amount, you have to invest more because you have to substitute brown capital with green capital. So this is having an effect in terms of potential output, as well as at the same time having an effect on demand, because all this additional investment, which is roughly considered to be 2% of GDP additional each year, around 2030, so with a gradual increase and staying at this level for another decade or so. So this is not unfeasible, but this is significant. So you will have at the same time a sort of negative supply shock and a positive demand shock. And you would have, as a consequence also, this reallocation of capital, this reallocation of labor. So a significant transformation of our economies with consequences for our usual variables and with consequences for growth. Let me end on two things I would like to add. One is that it's not going to be neutral for public finances. Once upon a time, we thought that climate action would take place through taxation, through setting a price for carbon, and therefore that would yield revenue for the state, and the state would then decide what to do with those revenues, perhaps lower other taxes. Increasingly, what's happening is that governments are basically avoiding putting too much emphasis on taxes because citizens don't like them. And they're putting much more emphasis on subsidies, on investment, on things that are actually costly for public finances. So the most likely is that it's going to be a cost for public finances, not a revenue. Is it bearable? Yes, most likely so, but it's nevertheless going to be a significant development. And finally, last point I wanted to put some emphasis on is the question of the credibility of climate policies. The difficulty we're facing is that their goals, their aims, and their actual policies. And the actual policies are much less ambitious than the aims, the stated aims, which themselves are not sufficiently ambitious to contain the rise in temperature below 1.5 degrees. So this gap is a credibility gap. And the problem with the credibility gap is that private agents, you want them to invest, you want them to develop new technologies, but at the same time, it all hinges on future policy developments that are uncertain. And I think this is an underestimated risk that you're asking private agents to invest on the basis of the expectation of future policy developments that are uncertain. The consequence is a higher capital cost for those agents, and the consequence is that there is a risk you would wish perhaps a policy to insure, because after all, it's a policy risk.